Ladies and gentlemen, what most silver investors don't realize is that markets don't move gradually when structural breaks begin. They reprice violently. We are now seeing early signals of a major shift in silver pricing dynamics, not driven by speculation, but by liquidity stress, industrial demand distortion, and a weakening trust in paper-based pricing mechanisms. When these forces converge, history shows the same outcome. Repricing is not linear, it is discontinuous. And once that break begins, it rarely announces itself in advance. The modern silver market is not what most investors assume it to be. On the surface, it appears to be a liquid, well-functioning system where price is discovered efficiently through global exchange trading. But beneath that surface lies a structure that is increasingly dependent on leverage, derivatives, and assumptions about physical availability that are becoming harder to sustain. The core issue is that silver pricing is still overwhelmingly driven by paper contracts rather than physical metal. Futures markets, options, and over-the-counter derivatives dominate daily price discovery. This creates an environment where the number of claims on silver far exceeds the amount of metal that can realistically be delivered if a significant portion of those claims are called for settlement. Under normal conditions, this imbalance is manageable because most participants have no intention of taking delivery. They are trading price exposure, not metal. However, systems built on leverage are stable only as long as confidence remains intact. The moment confidence begins to erode, the distinction between paper claims and physical assets becomes critical. What appears to be deep liquidity is in reality a chain of contingent obligations. Each contract depends on another layer of offsetting positions, and the assumption that these can be netted without stress is what keeps the system functioning. The strain begins to show when demand shifts from speculative exposure to physical settlement. This does not need to occur on a large scale. Even relatively small increases in delivery requests can expose bottlenecks. Registered inventories on exchanges represent only a fraction of total open interest. When market participants begin to question whether metal can actually be sourced in quantity, the pricing mechanism starts to adjust in ways that are not linear or gradual. Another dimension of strain comes from the concentration of short positioning. A significant portion of paper silver exposure is held on the short side by a limited number of large institutions. These positions are often justified as hedges or market-making activities, but in aggregate they create a structural vulnerability. When prices begin to move against these positions, margin requirements increase, forcing adjustments that can accelerate price movement rather than stabilize it. At the same time, physical demand is not static. Silver occupies a unique position as both a monetary and industrial asset. Unlike gold, which is primarily hoarded or held as a reserve asset, silver is consumed in industrial processes. Once used in electronic solar panels or medical applications, it is not easily recovered. This creates a slow but persistent drain on available supply. Over time, above-ground stockpiles can become less responsive to price signals because they are already allocated to long-term industrial use or investment holdings that are not easily liquidated. What makes the current environment more sensitive is the interaction between these physical constraints and the structure of financial markets. In a highly leveraged system, price stability is not determined by supply and demand in the traditional sense, but by the willingness and ability of participants to maintain positions. When liquidity is abundant, leverage amplifies stability. When liquidity tightens, the same leverage amplifies instability. There is also a psychological layer that cannot be ignored. Markets operate on collective belief systems as much as on balance sheets. As long as participants believe that paper silver is fully convertible into physical metal under stress conditions, the system functions smoothly. But that belief does not need to collapse entirely to create disruption. It only needs to weaken at the margins. Once large participants begin to hedge against delivery risk rather than just price risk, the feedback loop changes. The transition from a confidence-based pricing system to a constraint-based pricing system is rarely gradual. It tends to appear as sudden dislocations, gaps between futures and spot prices, and periods of sharp volatility that seem disconnected from news flow. In reality, these are symptoms of a deeper adjustment taking place beneath the surface. What is often misunderstood is that structural strain does not require a collapse of the system. It only requires a reevaluation of risk. When participants begin to demand higher compensation for holding short exposure, or when physical premiums begin to widen consistently, the market is effectively signaling that previous assumptions about liquidity and convertibility are no longer fully reliable. In such environments, price behaves differently. It becomes less of a smooth reflection of macroeconomic conditions and more of a pressure valve for underlying imbalances. The adjustment process is not orderly because the underlying structure is not designed for symmetric stress. It is designed for efficiency under normal conditions, not resilience under extreme ones. The key point is not that the system fails abruptly, but that it shifts state. And when that shift begins, it is rarely recognized in real time. It is only understood in retrospect once pricing has already moved to a new equilibrium that reflects physical reality rather than paper abstraction. Silver is often misunderstood because it sits at the intersection of two very different worlds. On one side, it is treated as a financial asset traded through futures contracts and held in investment portfolios as a store of value or a speculative instrument. On the other side, it is an essential industrial input embedded in technologies that define the modern economy. The tension between these two roles is now becoming more important than at any point in recent decades. The industrial dimension is no longer marginal. Silver is a critical component in solar energy systems, particularly photovoltaic cells, where its electrical conductivity is difficult to replace without efficiency losses. It is also widely used in electronics, medical devices, semiconductors, and advanced manufacturing processes. Each of these sectors is growing, not in a cyclical sense, but structurally, driven by long-term technological and energy transitions. What makes this significant is that industrial demand is not easily reversible. Once capacity is built in sectors like renewable energy or advanced electronics, the demand for inputs becomes persistent. Solar installations, for example, do not disappear when prices rise. Medical and defense applications are similarly inelastic. This creates a baseline level of consumption that steadily absorbs available supply, regardless of price fluctuations in financial markets. Unlike gold, silver is consumed rather than merely stored. When it is used in industrial processes, it is dispersed in quantities and forms that are often uneconomical to recover. This means that a portion of global silver supply is effectively removed from the tradable pool every year. Over time, this creates a structural drain on above-ground inventories, even if mining output remains stable. The mining side of the equation is not responding with the same flexibility as demand. Silver is frequently produced as a byproduct of mining for other metals such as copper, lead, and zinc. This means that silver supply is not always responsive to silver prices alone. Even if silver prices rise, production cannot always increase proportionally because it depends on broader base metal mining economics. This introduces a rigidity into the supply side that is often underestimated. At the same time, global demand is becoming more geographically diverse. Industrial consumption is no longer concentrated in a few advanced economies, but is increasingly distributed across emerging markets as well. Industrialization, electrification, and digital infrastructure expansion are all contributing to a wider base of silver consumption. This broadening of demand reduces the ability of any single region to offset supply pressures through substitution or efficiency gains. The interaction between industrial demand and investment demand is where the system becomes more sensitive. In periods of financial uncertainty or currency instability, silver often attracts additional investment flows due to its historical monetary role. When this occurs simultaneously with strong industrial consumption, the competition for physical supply intensifies. The same ounce of silver is effectively being pulled in two directions, as an industrial input that is consumed and as a financial asset that is hoarded. This dual demand structure creates a condition where available liquidity in physical markets can tighten rapidly. Unlike financial instruments, physical silver cannot be created through balance sheet expansion. It must be mined, refined, and delivered. When industrial users secure long-term contracts to ensure supply continuity, less metal remains available for spot or near-term market clearing. Inventories held in visible warehouses and exchange-approved storage facilities provide only a partial picture of actual availability. A significant portion of above-ground silver is already allocated either to industrial contracts or to long-term holders who are not price-sensitive in the short run. This means that the freely available float is smaller than headline inventory figures suggest. As industrial consumption continues to grow, it gradually reshapes the structure of the market without requiring dramatic shocks. The adjustment is incremental, but persistent. Each year, a portion of supply is absorbed into permanent or semi-permanent use, while mining output struggles to fully offset this depletion. Over time, this creates a cumulative tightening effect that is not always visible in short-term price charts. What is particularly important is that industrial demand does not typically retreat in response to higher prices in the same way that discretionary financial demand might. Factories do not easily substitute away from silver when it is embedded in critical components without incurring performance or efficiency costs. This reduces the elasticity of demand and increases the sensitivity of the market to supply disruptions. The result is a gradual but meaningful shift in the underlying balance of the system. Silver is becoming less of a freely available commodity and more of a strategically allocated input. This transition does not announce itself loudly. It appears through tightening lease rates, periodic shortages in physical delivery channels, and a growing divergence between paper pricing and real-world procurement conditions. Ultimately, the most important change is not in headline production or consumption figures, but in the structure of availability. When industrial users prioritize security of supply over price optimization, and when investment demand begins to reemerge in parallel, the market slowly transitions into a state where marginal ounces matter disproportionately. In such a system, small changes in demand or supply conditions can produce outsized effects on pricing, not because of speculation alone, but because the underlying physical balance has become increasingly constrained. Liquidity has become the silent but dominant force behind price behavior in modern markets, and silver is no exception. What once appeared to be a simple reflection of supply and demand fundamentals is now increasingly shaped by the availability, cost, and velocity of money flowing through the financial system. In practice, this means that price discovery is less about physical scarcity in the traditional sense and more about the conditions under which capital can be deployed, rolled, and leveraged across derivatives markets. In a highly financialized system, liquidity is not just cash on the sidelines. It is the ease with which positions can be entered, maintained, and exited without forcing distortions in price. When liquidity is abundant, even large positions in commodities like silver can be absorbed without significant disruption. Market participants can hedge, roll contracts, and extend leverage with minimal friction. Under these conditions, price movements tend to be smoother, and volatility is often suppressed because funding is readily available to support existing structures. However, when liquidity tightens, the entire pricing mechanism begins to behave differently. It is not simply that there is less money in the system, it is that the cost of maintaining exposure rises, and the willingness of institutions to extend balance sheet capacity declines. This shift alters incentives across the board. Traders reduce leverage, market makers widen spreads, and hedging becomes more expensive. These adjustments do not occur uniformly, and as a result, price behavior becomes more erratic and sensitive to marginal flows. Silver, in particular, is highly responsive to these liquidity dynamics because of its deep integration into derivatives markets. A large portion of trading activity is not driven by physical exchange but by futures contracts and leveraged financial instruments. These instruments rely on continuous access to funding and the ability to roll positions forward without disruption. When liquidity conditions are stable, this process is largely invisible. When conditions tighten, the mechanics of rolling exposure become more complex and more costly. One of the most important transmission channels is margin. As liquidity contracts, margin requirements tend to rise. This forces participants to either reduce position size or allocate additional capital to maintain existing exposure. In either case, the effect is the same. Selling pressure increases, not because of changes in long-term conviction, but because of short-term funding constraints. This is a critical distinction, as it means price movement can be driven by liquidity stress rather than fundamental reassessment of value. Another layer involves the behavior of intermediaries. Dealers and liquidity providers are essential to maintaining orderly markets, but their willingness to absorb risk is directly tied to funding conditions and balance sheet capacity. When liquidity is abundant, they can warehouse risk and smooth price fluctuations. When it tightens, they retreat, and the market loses an important stabilizing mechanism. This withdrawal of liquidity support amplifies price swings and reduces the depth of order books, making the market more vulnerable to sharp movements. In silver markets, this effect is compounded by the presence of significant leveraged short positioning. When liquidity is easy, these positions can be maintained with relatively low cost and minimal stress. But when funding conditions shift, the cost of maintaining short exposure rises, and even small price increases can trigger forced adjustments. These adjustments are not necessarily driven by changes in outlook, but by the mechanics of risk management under tighter financial conditions. What emerges is a feedback loop. Tightening liquidity leads to higher volatility, which increases margin demands, which in turn forces further deleveraging. This process can accelerate quickly because it is self-reinforcing. Price moves that might have been absorbed in a more liquid environment instead become catalysts for additional forced activity. At the same time, physical markets begin to reflect these financial stresses. As paper liquidity becomes constrained, participants with access to physical metal gain relative advantage. Premiums can widen, delivery requests can increase, and the distinction between spot and futures pricing becomes more pronounced. This divergence is not merely a pricing anomaly, it is a signal that financial liquidity is no longer fully aligned with physical availability. It is also important to recognize that liquidity is not evenly distributed across time. It tends to cluster around specific funding cycles, policy expectations, and macroeconomic conditions. Changes in interest rate expectations, central bank balance sheet policy, and global dollar funding conditions can all have immediate effects on commodity liquidity. Silver is a relatively small and highly leveraged market compared to other asset classes, tends to react more sharply to these shifts. Ultimately, liquidity conditions determine not just the direction of price, but the manner in which price moves. In abundant liquidity environments, adjustments are gradual and orderly. In constrained environments, they become abrupt and discontinuous. The underlying fundamentals of silver may evolve slowly, but the pricing response to liquidity shifts can occur rapidly and with little warning. In this sense, liquidity does not merely influence price. It defines the environment in which price is discovered. And when that environment changes, the market often appears to move in ways that are disconnected from fundamentals, when in reality it is reacting precisely to the most powerful variable in the system. The divergence between paper pricing and physical reality in silver is not a temporary anomaly. It is the result of a long-term structural evolution in how the market functions, where financial claims on metal have expanded far beyond the actual metal available for immediate delivery. On the surface, price discovery still appears to be efficient, continuous, and globally integrated. But beneath that surface, a growing imbalance is emerging between what is priced in contracts and what exists in physical form. The paper market represents obligations, not necessarily ownership of deliverable metal. Futures contracts, options, and unallocated over-the-counter positions all contribute to a system where multiple claims can exist against the same underlying ounce. Under normal conditions, this structure functions because most participants are not seeking physical settlement. They are engaged in exposure management, hedging, or short-term speculation. This allows the system to operate with a level of leverage that would otherwise be unsustainable if physical redemption were widely demanded. However, this equilibrium depends entirely on continuity of trust and the assumption that conversion from paper to physical is always possible at or near prevailing prices. When that assumption begins to weaken, even at the margins, the pricing relationship between paper instruments and physical metal starts to shift. The first sign of this shift is not a collapse in price, but a divergence in behavior between paper liquidity and physical availability. Physical silver operates under a different set of constraints. It must be mined, refined, transported, and stored. It exists in finite quantities in registered inventories, private vaults, industrial stockpiles, and investment holdings that are not always accessible to the market. Unlike paper contracts, physical supply cannot be expanded in response to trading activity. It is fixed in the short term and only adjusts slowly over time through production and consumption cycles. As demand for physical metal increases, whether from industrial users, long-term investors, or institutions seeking delivery, the available flow can tighten quickly. This tightening does not always immediately reflect in futures pricing because paper markets can continue to function based on existing liquidity and the assumption of offsetting positions. However, the underlying physical strain begins to manifest through premiums, lease rates, and delivery delays. A widening spread between paper and physical pricing is therefore not merely a technical detail. It is a signal that the two layers of the market are beginning to operate under different constraints. Paper pricing reflects expectations, positioning, and liquidity conditions. Physical pricing reflects availability, logistics, and willingness of holders to release metal at current levels. When these two begin to diverge, it indicates that the market is transitioning from a purely financial equilibrium to one that is increasingly governed by physical scarcity. One of the key drivers of this divergence is the structure of exchange inventories. Reported stocks on major exchanges represent only a portion of total supply, and even within those inventories, not all metal is freely available for delivery. Some is already allocated, some is encumbered, and some is held by participants who are not sensitive to short-term price incentives. This means that the true free float, the amount of metal that can realistically meet sudden demand, is significantly smaller than headline figures suggest. At the same time, industrial consumption continues to absorb a steady portion of global supply. Once silver enters industrial applications, it is effectively removed from near-term circulation. This creates a gradual but persistent reduction in available metal over time. When combined with investment demand, which tends to rise during periods of macroeconomic uncertainty, the pressure on deliverable supply increases further. In such conditions, the paper market can continue to display stability even as physical conditions tighten underneath. This is because paper pricing is heavily influenced by derivatives, liquidity, margin conditions, and the ability of participants to roll positions forward. As long as these mechanisms remain functional, price signals can remain anchored within a relatively narrow range, but this stability can become misleading when it is no longer fully connected to physical reality. The widening gap emerges most clearly during periods of stress. When delivery requests increase, or when large participants seek to convert paper exposure into physical metal, bottlenecks can appear. These bottlenecks are not always visible in advance because they are absorbed within the structure of contracts until a threshold is reached. Once that threshold is crossed, adjustments tend to occur rapidly, often through abrupt repricing of physical premiums rather than gradual changes in futures markets. What makes this dynamic particularly important is that it reflects a shift in the nature of trust within the system. As long as participants believe that paper claims are fully convertible into physical metal under all conditions, the divergence remains contained. But when that belief begins to weaken, even partially, behavior changes. Participants begin to prioritize physical possession over paper exposure, and this behavioral shift accelerates the divergence further. In the end, the widening gap between paper and physical silver is not simply a pricing inefficiency. It is a reflection of structural tension between two parallel systems, one built on financial abstraction and leverage, and the other grounded in physical availability and logistical constraint. When these systems begin to drift apart, the resulting adjustments are rarely smooth. They tend to appear as sudden revaluations that bring paper prices back toward the realities of physical supply, often in ways that are only fully understood after the adjustment has already occurred. Markets do not usually turn at moments of maximum visibility. They turn in the quieter phase that follows, when the initial signals of change are present but still widely dismissed. In commodity markets like silver, this phase is often defined less by price action and more by psychology. It is the period where information is available, anomalies are observable, and yet the dominant reaction remains disbelief. This psychological stage is critical because it determines how long structural imbalances can persist before being reflected in price. Even when underlying conditions are shifting, whether in liquidity, physical availability, or industrial demand, participants tend to interpret these developments through the lens of prior experience. If previous cycles resolve without major disruption, the assumption naturally forms that this cycle will behave similarly. That assumption becomes a stabilizing force in itself, delaying adjustment. Disbelief is not the absence of information. It is the rejection of its significance. In silver markets, this often appears when physical indicators begin to diverge from paper pricing signals. Premiums may widen in certain regions, delivery pressures may emerge intermittently, or lease rates may fluctuate more than historical norms. Yet these developments are frequently categorized as temporary distortions rather than early expressions of structural change. The reason for this response is rooted in how financial participants are conditioned to interpret volatility. Modern markets have experienced repeated periods of stress followed by stabilization through liquidity provision and policy intervention. This reinforces the belief that dislocations are self-correcting. As a result, even when market structure begins to shift, the default expectation is reversion rather than continuation. In the case of silver, this mindset is particularly entrenched because of the long-standing dominance of paper pricing mechanisms. For years, the futures market has successfully absorbed shocks, managed positioning imbalances, and maintained an appearance of orderly price discovery. This history creates confidence that the system is robust enough to handle emerging stresses without fundamental repricing. That confidence becomes a psychological anchor even when empirical signals begin to challenge it. During the disbelief phase, analytical explanations tend to dominate interpretation. Rising premiums are attributed to logistics, temporary supply chain issues, or seasonal demand fluctuations. Changes in inventory levels are viewed as routine fluctuations rather than directional shifts. Even tightening liquidity conditions are often framed as cyclical rather than structural. Each individual signal is explained away in isolation, preventing the formation of a coherent narrative of change. What is often overlooked is that systemic transitions rarely announce themselves through a single definitive event. Instead, they emerge through accumulation. Multiple small distortions begin to align in the same direction. The spread between paper and physical markets becomes more persistent. Short-term corrections fail to fully close gaps. Price reactions to demand shocks become sharper and less predictable. Individually, none of these developments appear decisive. Collectively, they indicate that the underlying equilibrium is evolving. The psychological barrier to recognizing this evolution is significant. Admitting that a structural repricing may be underway requires rejecting the assumption that existing frameworks remain fully valid. It implies that liquidity conditions, leverage structures, and physical constraints are interacting in a way that is not fully captured by prevailing models. For most participants, this is an uncomfortable conclusion, and therefore it is deferred. This deferral creates the illusion of stability. Prices may continue to trade within familiar ranges even as underlying pressure builds. Volatility may appear episodic rather than directional. In such an environment, the absence of immediate breakdown reinforces the belief that no fundamental shift is occurring. Stability itself becomes evidence against change, even when that stability is increasingly dependent on fragile conditions. The most important feature of the disbelief phase is that it suppresses adaptive behavior. If participants fully recognized that a repricing process was underway, positioning would begin to adjust in advance, exposure would be reduced, hedges would be restructured, and physical allocation would increase. Instead, because the signals are discounted, positioning remains broadly unchanged. This delays the adjustment process and concentrates it into a shorter future time frame. Eventually, however, physical constraints and financial pressures begin to override interpretation. When delivery stress persists or when liquidity conditions tighten further, the cost of maintaining existing positions rises. At that point, behavior shifts from interpretation to reaction. The market moves from debating whether change is occurring to adjusting to the reality that it already has. By the time this transition is widely acknowledged, much of the repricing has already taken place. The disbelief phase does not prevent adjustment, it compresses it. It allows imbalances to persist longer than they otherwise would, and in doing so increases the intensity of the eventual correction. What appears gradual in perception is often nonlinear in outcome, because the underlying adjustment accumulates beneath the surface of maintained confidence until it can no longer be contained.